In this video, I want to comment on what happened this week. The stock market was down. The year-to-date performance for 2025 is now down, negative -1%. That's not the end of the world, but that's not a good start for the year. And I want to give you some tips on how do you benefit from this situation. How do you take advantage of this situation? Because now stocks are down, you have some panic, but we are long-term investors. So we are okay with the volatility and we invest in great businesses. So how do you take advantage of this volatility to make more money in the very long term? Welcome to this YouTube channel. My name is Christophe Nour and I've been investing in the stock market for almost a decade now with a performance of 25% per year. And I love this moment of volatility. Now stocks are down in a big way. We have some massive moves, you have some macro data. And if you look at the fear and greed index, we are in fear territory. And this is 27 score out of 100. So this is a good estimation of the sentiment in the market. And if this goes below 25%, we will reach extreme fear. Now let me show you something. Let me show you the timeline of the fear and greed index. You see that now we have been in fear territory for a while, and every time you saw a drop in sentiment, people were having some panic, were panicking about the markets, stocks went down. This was only temporary and it rebounded after some weeks. So it's very likely that this will be similar. If you only invest in this moment, it's likely that you will make some big money on this one. So first, let me tell you that this is completely normal. This is the way markets work. We have moments of euphoria and then pessimism. Now let me explain a little bit what happened, why we have this situation. So we've been in the fear territory for a while. First, because a few weeks ago, it was in December 2024, when the Fed basically said that they are thinking about cutting rates in 2025, but cutting rates by not that much. The market right now is expecting that the Fed will continue to cut interest rates in 2025. But how many times do you cut rates? Once, twice, 3 times. So people at the beginning of December expected 3 rate cuts. The Fed said, no, it will be 2 rate cuts. And this week we had some data showing that maybe we will never have a rate cut. We will have 0 rate cuts for 2025. Why? Because this week we had the news that the job market was fine. The job market was fine. People are getting jobs. People are getting hired by companies, and we see no sign of recession. So we have inflation, yes, but we see no sign of recession, of struggling economy. Seems like the employment is fine in the US. And if the employment is fine in the US, if you have a strong economy, why would you cut rates? Normally, you cut rates to help small businesses. You help people on their mortgage in case the economy is slowing down. But the economy in the US is not slowing down, so why would you cut rates? Frankly, that is understandable. Second thing, we see some signs that inflation is coming back up. The Fed target for inflation is 2%. We never reached to 2%, like in the past few years. And now it's about 3, coming back up to 4%. We have some key data showing that inflation is rebounding. So if you cut interest rates, this will fuel inflation. And we want to avoid the situation we had in 2021 when inflation was really high at 8 or 9%. So we want to calm down inflation, and interest rates are a great tool to do that. So if you reduce interest rates and if you continue to cut interest rates, it will fuel inflation, and this is not good for the economy. So based on these 2 things, strong job market and strong inflation, why would you cut rates? That's a very good way of thinking about macro. Why would you cut rates? That's very interesting. And if you don't cut rates, interest rates stay high, interest rates stay at 5%. And let me tell you why stocks went down. Because now I'm just talking about macro and things that will happen in the short term, but people are panicking. Okay, Let me show you how you build a DCF. DCF. Now I will talk about valuation and how do you value companies, right? That's a DCF, discounted cash flow model. So the goal of the discounted cash flow is to estimate what will be the cash flows that a business, a stock, will produce in the future and discount them back. So you have a company, I don't know, Facebook, Google, Apple, anything that will produce free cash flow in year one. So that's free cash flow year one, and you have your 1 plus discount rate. Discount rate is your, let's say it's your interest rates. It's 5%. And then you do plus free cash flow. Oh, it will be long. I have a pad, I can't write. Free cash flow 2. And then you have 1 plus your interest rates. Square, etc., 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 and you continue like this. And then, I mean, this is your free cash flow that is discounted over the years. If R is the interest rates, right? If the R is low, like if this is 0, for example, you just have the DCF, discounted cash flow, is the sum of the free cash flow in the future. So basically the valuation will be very high. If your interest rates is high, your denominator is getting higher and your DCF will be lower. If the R is 5, 10, 15%, it will be a drag on the DCF. And you know, companies, Wall Street analysts, they focus on DCFs. I mean, I've done this so many times. So you focus on DCF and you have the intrinsic value of a business. S, let's put S for stocks. That's the stock price, SP. And that's where you put your price targets, etc. So the higher the interest rates, the lower the share prices, the intrinsic value of share prices. So just mathematically speaking, you get a sense of the relationship between interest rates and stock prices. And there is a saying from Warren Buffett saying that interest rates is to stock prices what gravity is to matter. So the higher the stock price, the interest rates, the lower the stock prices. And let me give you other tips about how to think about interest rates. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Interest rates is the cost to borrow, right? Now, there is a fairly good amount of debt in the US economy. I don't think a lot of people would disagree to this sentence. If interest rates, I for interest rates, are high, it deters people from getting more debt. And this is very similar for companies. If interest rates are high, companies will not benefit from debt. And you know who has a lot of debt and who can't negotiate the debt? That's the small caps. The small caps. If you look at the Russell 2000, this is an index like the S&P 500, Dow Jones, but they focus on, I mean, you have a lot of small caps, mid caps, and these companies can't negotiate the rates for their debt. These companies sometimes have a lot of debt. These companies don't have a lot of earnings growth, so these companies will suffer the most when it comes to high interest rates. So if interest rates stay high, the Russell 2000 will stay low. These companies will suffer immensely. And you can't say the same thing about the Magnificent Seven, by the way, because for the Magnificent Seven, they don't have a lot of debt. So they are not really much impacted by the interest rates. So what we saw this week is a panic, some panic in the market, some fear in the market. People are selling their stocks in panic, okay, because of interest rates and this relationship between DCF, etc. And you see that some small caps are getting hammered really hard because of this, because of interest rates, because of debt, and that is not good for the economy, especially since inflation is picking up. Inflation, I mean, that's I'm thinking out loud right now. Inflation is bad for the global economy, especially if you don't have pricing power as a company. Inflation is basically prices going up, raw materials cost going up, and to keep your margins as a business, if you are a company, to keep your margins, you need to increase your prices, right? I mean, the Louis Vuitton bags, the Hermes bags, they will increase their prices. The iPhone, they will increase their prices for Apple, and it's okay. As an Apple customer, I'm okay. I will buy more. I will pay more for an iPhone. Okay, so Apple, Louis Vuitton, LVMH, Hermes have pricing power. But there are some companies that don't have pricing power. Small companies in the Russell 2000, they don't have pricing power. So if you have pricing power, inflation will be reallocated from raw materials, price of products, and the customer will pay the price. So it's not a plus or a minus, it's an equal. I mean, they will pass through the inflation for pricing power for big companies. What am I writing? So for pricing power, let me check this. For big companies with pricing power, they have pricing power. It will be an equal situation. For small companies, not a lot of them have pricing power. It will be definitely a minus. And that's the reason why you have this small cap industry, mid cap industry, Russell 2000, 3000 getting destroyed this week. And if the economy is not changing, it's likely that the Russell will continue to struggle because these companies have some debt. These companies will suffer from high interest rates, high inflation, and that's basically not good. So be very cautious if you invest in small caps and mid caps. I would say be very cautious for 2025 because it can completely destroy your performance. And if I had one tip, and I will leave this video with that, for 2025, you will have a lot of uncertainties in the global world, in the tech, presidential, political stuff, anything. You will have a lot of uncertainties like any year, but it's a high chance we will have some more inflation, higher interest rates. So I would focus on companies with pricing power. This is really, really interesting, and that is exactly what I try to do with my portfolio right now. That is public right now. You can type my name on eToro. My portfolio is completely public. I only invest in companies with pricing power. If inflation is 5%, these companies I'm invested in can increase their prices of their products by 5% or more, and customers will still pay. So that's, this method has worked in the past, is working right now, and will continue in the future. So I don't really worry about this one. So how do you benefit from this environment? I told you some tips to understand the situation, to focus on companies with pricing power. And actually, given the global market panic right now, you can buy some stocks right now. I see some companies that are fairly valued or cheaply valued with pricing power, available in the US, in Canada, in Europe. You have some companies that are great. And if you don't buy when you have fear in the market, when do you buy? This is a perfect environment. This is a short-term issue. I mean, having more jobs is not a global issue. It's not a very consequential issue. This is a good issue to have a strong economy. So the US economy is hot, inflation is hot, interest rates are likely to stay high at 5%. So you want to invest in strong companies available at a fair price right now. And this is exactly what we have for some stocks. So I wish you good luck for the rest of the year, but this was my 2 cents for this week. I think I will continue to buy more cheap stocks the coming week. So we will see in the market, and I wish you a good day. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. click the first link in the description below to get more information. You will get a video, a short video that explains how everything works completely for free. No need for your mail address, just click the first link in the description and I'll see you on the other side.